Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ZOOMINFO Technologies Inc. Annual Report. ZOOMINFO Technologies Inc. offers a range of businesses and services to professionals across various industries. The company's primary platform provides go-to-market intelligence and engagement tools for sales, marketing, operations, and recruiting teams. This includes workflow tools, organization and professional information, predictive lead and company scoring, buying signal monitoring, automated sales tools, and deal cycle tracking. The company offers several paid products tailored to specific needs: ZOOMINFO Copilot, sales, marketing, operations, talent, and light. These services cater to a broad range of clients, from global enterprises to small businesses across various sectors such as software, business services, manufacturing, telecommunications, financial services, media, transportation, education, hospitality, insurance, and real estate. ZOOMINFO's platform is designed to help users identify target customers, craft messages, engage with decision-makers, and track progress throughout the deal cycle. By providing a comprehensive suite of tools and information, ZOOMINFO aims to support professionals in making informed business decisions and driving sales growth. Der Aktienkurs von ZOOMINFO Technologies Inc. ist im Vergangenen Jahr durch mehrere Uranus beeinflusst worden, insbesondere Bezug auf Unternehmensbericht und Prognosen. Ein bemerkenswerter Rückgang, der zu einem Rückgang von über 49% beigetragen hat, ist auf die Veröffentlichung der Ergebnis für das vierte Quartal 2025 und den Ausblick für das erste Quartal sowie des Gesamtgeschäftsjahr 2026 zurückzuführen. Die wichtigste Ursache für diesen Rückgang war die Veröffentlichung der Ergebnis für das vierte Quartal 2025 und des Ausblicks für 2026 im Februar 2026. Obwohl ZOOMINFO besser als erwartet Gewinn und Umsätze meldet, enttäuscht das Unternehmen mit einem schwächeren Ausblick auf ein Wachstum von nur etwa 1% im mittleren Bereich. Dies führt zu Bedenken bei den Anlegern und zu einem starken Ausverkauf der Aktien. Die geringeren als erwarteten Abrechnungen und Margen für das vierte Quartal trugen ebenfalls zur Besorgnis bei. Analysten reagierten mit Herbstufungen und gesenkten Kurzielen, wobei sie zunehmenden Wettbewerb, einen haltend Netto-Kundenbindungsrate von 90% und Unsicherheiten bezüglich der Unternehmensschuld und eines neuen Aktienrückkaufprogramms anfuhrten. Der Wert der ZOOMINFO-Aktie sank 139% am 10. Februar 2026 auf $630. ZOOMINFO Technologies Inc. maintains a market capitalization of $2 billion, broadly in line with the industry peer group. ZOOMINFO Technologies Inc. trades at a lower price-to-earnings ratio of 17 times and a lower price-to-book ratio of 1.3 times relative within the industry. This makes the stock valued slightly lower than its peers in the industry. This likely suggests that investors are less interested about the company, or it could be that the stock have not caught up to the industry valuation and should further be investigated. The leverage on the balance sheet appears elevated, with liabilities of 77% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has aggressively reduced its share count by more than 5% while revenue has grown, but assets and equity have declined. This suggests management may be prioritizing buybacks over reinvestment, raising questions about long-term growth prospects. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for a company are multifaceted. On the growth side, subscription services, particularly SaaS applications, have been a significant contributor to revenue. Additionally, unearned revenue has shown steady growth due to its 12-month recognition period, while usage-based revenue has experienced substantial growth in 2024 compared to 2023. Other revenue has also increased by $5.1 million, 51.5%, from 2023 to 2024. However, there are also drivers of revenue decline. Subscription revenue has decreased by $28.1 million, 2.3%, from 2023 to 2024, while other revenue has declined by $1.3 million, minus 40.7%, over the same period. It's worth noting that subscription revenue has been relatively stable over the past 3 years, but usage-based revenue has shown significant growth in 2024. Geographically, the United States accounts for a substantial 88–90% of total revenue, while the rest of the world contributes around 12%. The company also faces potential risks such as inflation, interest rate fluctuations, and foreign currency exchange rate changes that could impact its business, financial condition, and results of operations. Net income experienced a significant fluctuation between 2023 and 2025. Initially, it decreased by $107.3 million from 2023 to 2024 due to various factors such as declining demand for products and services, failure to raise additional capital or generate cash flows, increasing operating expenses, and the adverse effect of goodwill and intangible assets realization. However, in 2025, net income increased by $95.1 million compared to 2024, indicating a recovery. Profit margins also underwent changes during this period. The GAAP operating income margin saw an increase of 10 percentage points from 2024 to 2025, while the non-GAAP adjusted operating income margin rose by 1 percentage point. However, the gross profit margin fluctuated without any specific change mentioned. Notably, the net income margin increased significantly from 2.4% in 2024 to 9.9% in 2025. The reasons behind these changes are multifaceted. Higher debt levels and interest rate fluctuations had a negative impact on financial condition and ability to raise capital. Additionally, declining demand for products and services, failure to generate cash flows, and increasing operating expenses contributed to the initial decline in net income. However, by 2025, the company seemed to have recovered, with an increase in net income and profit margins. The company's financial performance indicates a consistent trend of generating positive operating cash flow over the past 3 years. In 2023, the company reported an operating cash flow of $434.9 million, which increased to $465.4 million in 2025. This upward trend suggests that the company is effectively managing its operations and generating sufficient cash to support its growth. The increase in operating cash flow from 2023 to 2025 also indicates a positive direction for the company's financial health. The company's debt level and interest expenses have undergone significant changes over the past few years. In 2025, the total debt increased to $1.332 billion, a substantial jump from the initial $0 outstanding balance in 2024. This increase is comprised of various loan types, including first lien term loans and senior notes. The company's interest expenses have also fluctuated significantly. In 2023, interest expense was at its highest at $45.2 million. However, it decreased to $39.3 million in 2024, before increasing again to $42.6 million in 2025. This represents a net change of plus 6.1% from 2024 to 2025. The data suggests that the company's debt level has increased significantly, while its interest expenses have fluctuated but ultimately remained relatively stable. The increase in debt is likely to result in higher interest expenses in the future, which could impact the company's financial performance. The financial performance of various regions has been analyzed, revealing both positive and negative trends. In the United States, revenue saw a significant increase from $1,065.1 billion in 2024 to $1,103.7 billion in 2025, indicating strong economic growth. This upward trend is a testament to the country's resilience and adaptability in the face of global challenges. On the other hand, the rest of world region experienced a decline in revenue from $159.4 million in 2023 to $145.8 million in 2025. Furthermore, international regions are facing potential poor performance due to geopolitical and macroeconomic risks, which pose significant threats to their economic stability. Management is expressing a cautious outlook for the company, citing uncertain industry conditions, weaker economic conditions, competition, and regulatory changes as challenges. Despite these challenges, management is focused on acquiring new customers, strengthening contributory networks, and expanding value provided to customers. In terms of growth and expansion, the company expects stable or declining general and administrative expenses over time, but anticipates an increase in amortization of other acquired intangibles if additional acquisitions are made. Management is also investing in research and development to drive customer value through new features and functionality. Financially, management is prioritizing cash generation and expense management, using non-GAAP financial measures such as adjusted operating income and adjusted operating income margin to evaluate performance. The company expects future profitability may change due to market conditions and business execution. Management is also pursuing significant acquisitions, which would result in additional debt or equity sales, and investing in property and equipment as the company grows. However, the frequency and magnitude of future acquisitions or investments cannot be predicted. In terms of debt and leverage, management is managing debt through interest rate swaps and will continue to do so as existing contracts mature. The company's total net leverage ratio to cash EBITDA as of December 31, 2025 was 2.4x. Overall, management is focused on executing business plans and tax planning strategies while navigating uncertain industry conditions and prioritizing cash generation and expense management. The company has made strategic moves through acquisitions and divestitures. In terms of acquisitions, the company has expressed its intention to acquire and invest in companies or technologies that align with its goals. This approach is supported by cash generated from operations supplemented with debt offerings, as mentioned on page 62. On the other hand, the company has also considered disposing of material assets or operations through divestitures. This action is seen as a potential solution to address liquidity problems, as highlighted on page 33. The company's financial activities over the past few years have been notable for two key aspects. Firstly, it has not paid dividends to its shareholders. This decision suggests that the company is prioritizing reinvestment in its operations and growth rather than distributing profits to investors. On the other hand, the company has engaged in share buybacks. Specifically, between 2023 and 2025, a total of 109,892,076 shares were repurchased by the company. This move indicates that management believes the stock is undervalued and wants to reduce the number of outstanding shares, thereby increasing earnings per share for existing investors. There are concerns about inventory buildup and potential supply chain disruption. The increase in backlog and remaining performance obligations, particularly the non-current portion, suggests that companies may be holding onto more inventory than usual. This could indicate a buildup of unsold products or materials. While there is no explicit mention of supply chain disruption as a concern, some indicators suggest potential issues. For instance, accounts payable increased by $10.3 million in 2025, which could imply difficulties in paying suppliers on time. Additionally, the decrease in purchases of property and equipment and other assets by -$76.1 million in 2025 may indicate that companies are being cautious with their spending, possibly due to concerns about supply chain reliability. These indicators suggest that companies may be experiencing some level of disruption or uncertainty in their supply chains, which could have long-term implications for their operations and profitability. That concludes the financial summary for ZOOMINFO Technologies Inc. Feel free to comment below, and I will be happy to answer them when possible.